Welcome to Global Tax Talks, Tax in 60 Seconds. I'm Will Morris. There was not a huge amount of new news last week, so instead I want to talk about some of the reactions I heard to Pillar 2 when I was in Japan last week at the end of a trip to Asia. I'm well aware that because of the location of the US government, the OECD, and the EU, this often tends to be a very US/Northwest Europe focused discussion. But there is both a lot of activity and interest in these questions in other parts of the world, and Japan, a G7 country, with one of the most important trade associations in the world, the Keidanren, as well as many forward-looking corporations, is an important player in this discussion. Bottom line, I think many Japanese companies are unhappy with the way Pillar 2 has developed. I heard one word again and again: simplification, simplification, simplification. Japanese companies have taken seriously their obligations to file under Pillar 2 and the Global Information Return, and yet they feel the complexity is both shocking and unnecessary. The hybrid form of financial accounting makes complications and leads potentially to stranded tax costs. At the same time, as with corporations everywhere, the granularity going down ultimately to legal entities makes no sense from a business point of view. There, they've had to go hunting for information that governments will have no idea what to do with across a couple of hundred or so different data points. They've been hoping for a serious safe harbor, which offers meaningful simplicity, but the proposed permanent safe harbor, at least according to the companies that I spoke with, currently does not provide that. Then there's the cost of complexity. Some companies have invested substantial resources, as well as being quite innovative on topics that the OECD has not yet given guidance on, such as joint ventures and partially owned entities, and find that they will only owe maybe $10 or $15 million in additional tax, but with a compliance bill much higher than that because of the need to dig down into legal entities that have never been relevant to financial accounting. And that's still with the current CBCR safe harbor, which, for one reason or another, has some quite tricky thresholds that mean that high tax companies still don't always qualify. Add on top of that the very rigorous Japanese CFC rules, whose interaction with Pillar 2 can cause significant double taxation in some cases, and it seems fair to say that the Japanese business community is not terribly happy. Not least because even though there is momentum to reform and simplify those CFC rules in Japan, the Ministry of Finance may have to focus on P2 and side-by-side guidance this year. On the side-by-side agreement itself, while Japanese business does not display the same primal angst as some European businesses, nevertheless there is a concern that US business, but of course not just US, Chinese and Indian, and who knows who else, may get some advantage, particularly in terms of reporting. And also, with no clear path forward yet on non-refundable credits mentioned in the G7 agreement, again and again, the request/hope/demand keeps coming back to massive simplification, but with a weary acknowledgement that simplification is not at the top of the OECD's list of priorities. How did we get here, and how do we leave here to somewhere more sensible? Unfortunately, it's not clear. But if we want to genuinely move towards creating economic growth, then we will have to find a way. Anyway, thanks for tuning in, and come back next week so that you stay global tax ready.